all a very happy new year. Welcome to our session on 7531 Strategy for Equity SIP Investing. I'm Sharon. I will be the moderator for this session. Mr. Arun Kumar, our research head, will start the session.
Yeah, thank you so much, Sharon. Hi, everybody. Super nice to see you all in the beginning of this new year. So, wishing you all happy new year, and we'll start off with the presentation. See, broadly, the idea is that there's been a lot of SIP as a strategy. We've already heard a lot about it. Now, the question is, what is this 7531? There are some questions which keep getting repeated on an equity SIP. So, what we basically did was we tried to address most of these common questions that get repeated, and also try to figure out a simpler way to communicate to our clients, so that this whole thing about how long should you invest and where should you invest and what is the pain that you should take up when you're coming into an SIP, and most importantly also how do you increase it every year. We just thought, how can we communicate all this in a very simple format? And that's how we came up with this whole strategy called 7531. And also, apart from this, there are a few other slides where we kind of explain some of the common questions that most of our clients ask us. With that, I'll proceed. So if you look at the first, the idea is very simple. How does somebody become a successful equity SIP investor? The idea is to follow the 7531 rule. Now the question is, what is this 7531 as a rule? The first point is simple, that whenever somebody is looking to start an equity SIP, what is the time frame that they should look out for? Now, in our view, we should at least have a minimum of 7+ year time investment time frame. Now, the next question is, why not say 2 years, or why not say 3 years, or why not say 5 years? So what we actually did was we went back and looked at all the since July 1999. So which is almost like we have data for almost 22 years. So we looked at all the SIP timeframes and then figured out, saying that, hey, if somebody starts off with a 1-year SIP, what total number of SIPs that could have possibly been started was 262. And out of that, we said, what were the number of times where you made less than 0% on a 1-year basis? So we found that almost 1 out of 4 times you actually ended up with negative returns. So then we said, hey, 1 year is too short a time frame. So 1 year doesn't make the cut. Then we said, let's slightly extend this and probably check for 3 years. Now, in 3 years also, we had the same problem. While obviously the number of occurrences of negative returns reduced, we still found that almost 11% of the times, even after a 3-year basis, you still ended up with negative returns. So we said, okay, 3 years is also may not make the cut. And let's slightly extend it further and then increase it to 5 years. Now, in 5 years, the good part was that the negative return probability drastically reduced. So you almost have a very, very, very low odd of making negative returns. So now that negative returns are anyway, probability of negative returns are very, very low, we said, let's look at returns below 7%, because if you are doing an equity SIP for 5 years, you would at least need to beat an FD. So while negative returns is getting avoided on a 5-year time frame, we also asked, what is the chance that you might end up with less than 7% returns, which is also equally disappointing, because nobody comes into equities to get sub FD kind of return. So we found that there was almost a 10% odds of making less than 7% return. So we said, let us extend this further, and then we tested for 7 years. In 7 years, broadly, all of these get addressed. If you look at the chance of making a negative return, historically, you've never made a negative return on a 7-year basis. So that was great. And on top of it, the chances of you getting sub 7% returns was only 3%. So which means in both the bad outcomes, the odds of bad outcomes are significantly lower. And if you look at overall percentage of times where you made more than 10%, it was almost close to 80%. So overall, going by the data, we said 7 years looks like a very decent time frame for any equity SIP investor, irrespective of whenever you start. at least going by the last 22-year history, it looks like 7 year is a good time frame to look at investing, especially if you're starting an equity SIP. Now, again, so we also did chart basically shows what was the actual returns for Nifty 50 TRA if you had started on August 99, August 2000, August 01, and we did that for almost like the last 22 years at different points in time. So broadly, you can see that on a 7 year basis, historically, you've always made very, very good returns, even at a Nifty 50 TRA level. Had you chosen some good active funds, you would have made even higher returns. So broadly, it looks like 7 years, like what we tested in the data, the returns are extremely good over 7 year time frames for an equity SIP. But then again, the question comes that what if there is a sharp fall in those rare cases where maybe in the 6th year there is a large fall, or maybe 7th year, just when the 7th year is completing, you have a very sharp fall. Won't that impact the returns? 100% that will impact the returns. But that what we simply asked was, in those rare periods where at the end of the 7th year or probably in the 6th year you had a large fall, and because of which the returns were low, what was the solution? The solution was fairly simple. You just had to extend it by another 1 or 2 years. So you come in with a 7 year time frame. If you are a little unlucky and you end up in that 7 year time frame period where your returns are slightly lower, while it is not bad, it's still, say, less than 10% kind of returns. So what we did was we isolated all the periods where you got less than 10% returns on a 7 year basis. And then we simply asked the question, had you extended the time frame by another 1 to 3 years, were you able to make decent returns? And in most of the cases, by 8th year, your returns improved to more than 10%. And in those few cases where even in the 8th year, your returns did not improve, by the 9th year, you were almost in all of the cases, you ended up making more than, say, around 11% kind of a return. So overall, we found that if somebody comes in with a 7 to 10 year view, you always had a chance to exit at a return of more than 11%. Might be in the 7th year, might be in the 8th year, might be in the 9th year, but you always had a chance of exiting your SIP at a 11% returns going by the last 22 year history. So overall, going by the data, a good starting point for all of us to communicate to our clients is that to come in with a 7 year time frame into an equity SIP, so that your odds of making a very, very good return is very, very high. So this is the first part of the 7531. The next question was, okay, now I come in with a 7 year time frame. Which are the funds, or how do I pick my equity SIP portfolio? As we have communicated earlier, we use a simple strategy called the 5 finger strategy, where essentially the idea is to go diversify across different investment styles, which have been proven to work not just in India, but also across the world. Those styles that we have identified as quality, value, growth at reasonable price, mid and small cap as a style, and global funds. So if you combine one fund each from all these buckets and put together 5 funds together, we found that over 3 to 5 year time frames, you are able to make very decent returns. In fact, this actually shows the last 3 years we've been implementing this. So we've almost made, this data is slightly 1 month back. The recent data is almost, we have made close to 17%, vis-a-vis 15% for the Nifty 50 TRA. Now, the good part about the strategy is also in the long run, you are able to outperform by 2 to 3% over and above the index. And the most important question is, for this outperformance, did you take up higher risk? Now that you can see through this, where the blue line shows the 5 finger strategy's actual fall. So you can see that in all major falls, the 5 finger strategy has fallen far, far lower than the index. And also you can see that it's been fairly consistent over long periods of time. Almost you on a 5 year basis, you've always ended up outperforming the index. And also 80% of the times you have outperformed by more than 3%. So the second question's answer was that broadly diversifying across these 5 investment styles is a good way to build your equity SIP portfolio. Now these 2 parts are done. The third part is, what is this 3 things, right? What does the 3 stand for? What we have also seen is that while everybody starts their equity SIP, most of them, we see that they kind of give up on their SIP probably by the 2nd, 3rd, or 4th year. Now the question was why. Then we found that there are three common phases, which we call as just like SIP. There is we call the reverse of it as dip, where most of them end up giving up on their SIP during the dip phase. Now, what is the dip phase? First phase is the disappointment phase. Technically, your SIP returns probably dip to around 7 to 10%. Now, why is this a disappointing phase? Because it's not. It is better than FD, but you obviously did not start an equity SIP to get a 7 to 10% return. You were obviously expecting more. So this phase is more or less your clients are telling that, hey, but I expected far more. Right. So this is a disappointment. This is okay. It's not a great experience for clients, but they are still, most of them may be able to manage this phase. The second phase is the irritation phase, where basically even after 2 years or 3 years, you find that your SIP returns are between 0 to 7%. So technically you're saying, hey, even my FDs would have done better than this. Why did I have to waste my 3 years investing month on month with this SIP? Most clients end up giving up here. And then even let's say some people are able to survive this phase as well. The third phase is the most dangerous phase, which is the panic phase, where essentially probably after 2 year, 3 year, 4 year, 5 year, your SIP returns are actually negative. So which means whatever you have invested, the amount that you're seeing right now is far lower than what you invested. So this is the most dangerous phase, where most people stop their SIPs and take out the money completely from it. And the unfortunate part is that all these three phases more or less happened for all equity SIP investors. So when we tested for different starting points, we found that more or less 90% of the times you would have ended up in one of these three phases in the first 5 years. Now, this is how the data looks. I mean, again, the last 22-year data, you can see for somebody starting in Jan, almost till the first 3 years, you were in that panic phase where you are always in the negative. And you can see periods. So you can see red is the panic phase, which is sub-zero. The white phase is the disappointment phase, where it is between 7 to 10%. And then the yellow phase is 0 to 7%, which is the irritation zone. So you can see that how in the first 5 years, irrespective of when you start, at some point in time during your first 5 years, you will be taken through either one or two or all three phases, right? And most likely our clients are going to come to us and then say, hey, let's look at this June not file. Like after 3 years, 6 months, you are at minus 15%. But if you observe the funniest, the surprising part, right? Every time it is negative, you extend it by another 1 year or another 6 months or another 2 years, your returns dramatically jump. So for example, this June 5, you start, and then by 3 years, 6 months, your returns are minus 15. And then you extend by another 6 months, your returns jump from minus 15 to plus 14. And then another 6 months out, you are at plus 16. So this is very counterintuitive to our clients. But however, if they give up and if they stop their SIP at minus 15, then this plus 14 only remains in the paper while they have not actually experienced this. This is the tougher phase. These three phases is something that all SIP investors will go through, but the key point is they shouldn't give up. So the idea of 7531 is that when you're starting the SIP itself, let's beg this expectation that these three phases are almost like a given. So all equity and SIP investors should be okay that they will spend at least 1 or 2 years in these three phases, especially in the first 5 years. And they should not give up on their equity SIPs. Now, the key question is we want to dwell a little more on this because this is something which is not really talked about. Now, you might ask, hey, why does this happen, Arun? Like, is there something wrong? Like, why does an SIP suddenly suddenly dip to, say, minus 15%? Or why do these phases happen? Very simple. If you look at it, this shows the intra-year drawdown for almost every year, and you can see that a 10 to 20% kind of fall happens almost every year. Every year in Sensex, you have seen a 10 to 20% fall within the year. And most importantly, if you look at it once every 7-10 years, you also see that there is a 30 to 60% fall. So broadly, equity markets behave in such a way that 10 to 20% fall is a given every year, and on top of it you also have a larger fall of 30 to 60% fall every 7-10 years. Now let's do a simple math. Okay, there are two charts given. You can see the right hand side. What we did was we assumed that you have a 15% SIP return, but suddenly the market fell by 10%, 20%, 30%, 40%, 50%. How much will your SIP returns dip? Okay, now let's assume you had a 15% SIP return and then markets fell by 40%, like what happened in COVID. Now your returns, let's say if you are in the second year and you are actually seeing 15% returns, your client is all happy. Then suddenly COVID happens and in the next 1.5, 2 months, you are down by 40%. Your SIP return suddenly after 2 months from 15% is now down to minus 40%, right? And then same thing, but the same 40% impact, if it had hit your portfolio probably after 7 years, that is after 7 years, your returns are showing 15%. And then there's a 40% impact. You see that your return suddenly dip from 15 to 1%. So you can see that a 40% fall or a 30% fall or a 20% fall immediately has a large impact on your original SIP return. But the point is, the shorter the time frame, the impact is far, far more. So the same 40% eroded, brought your 15% SIP into a minus 20% return. Whereas after, say, if that same thing happened after 10 years, then your 15% SIP return drops to only 6%. While still 6% is still a big impact, but at least it's not bad as it's not going into negative. Now, the beauty is if you look at it over a 20-year period, the same impact of 40% fall, 15% SIP return drops it down to 11%. So you are still at a, so which means once you prolong your SIP, right, after your 7th year, 10th year, the impact of a large fall that happens in your portfolio is not that drastic. But however, in the first 5 years, even a small 10 to 20% fall, which almost happens every year, kind of dents your portfolio. And then if, let's say, we have the larger fall of 30 to 50%, then automatically your returns mathematically come drastically low. And most often than not, if let's say after 4 years your client sees minus 14% return, obviously they are going to sell out of this portfolio, right? So this is pure maths. That is why you are suddenly seeing returns coming down whenever there is a large fall. Now the key question is what happens post this. Now we saw how it suddenly jumped, right? What we did was, while that is only showing you a small snapshot, we went by each and every possible date, and then we asked whenever 2-year returns became negative or was sub 7% or was between the 7 to 10%, what happened if you extended it by 2 to 3 years? We found that almost, not almost, basically in every instance, in the next 2 or 3 years, it recovered drastically. You can see July 99. After 2 years, your returns was minus 17. But by the end of 5 years, you were at 11%. By the end of 6th year, your SIP was at 18%. You can see any of the instance, you can see that by the 5th to 7th year, you have almost recovered and you have a very, very decent return. Same thing we did for 3 years. Same logic we found. So that in the next 2 years, it drastically improved in each and every case. Again, for 4 years, if you're in the 4th year, if you hit the negative, what happens? After in the 5th or 6th year, it drastically recovers. Again, if in the 5th year, again, you can see that there's not much of negative return, because as I said, as your time frame increases, the impact of large negative falls gets subdued. So you can see mostly it is yellow or the gray area. And still you can see that how in the next 1 or 2 years, it drastically improves. Same thing happened for 6 years. Again, next 1-2 years, it drastically improves. Same thing for 7 years. So the broad idea is that while it might sound as naive, but the idea is that if you do not stop your SIP, continue your SIP and just extend it by 1 or 2 years, your return dramatically improve. Now the next question is, while okay, we understood why it fell, because like it's maths, like there's a large fall on your 15% or 12% SIP return, which drags it down. But why does it suddenly improve? Because suddenly, let's look at a 2-year, right? It is, say 3 years, it is minus 15% in August 99. And then by the 5th year, it is 13%. It sounds like magic, right? How can it be minus 15 after 3 years? And then I just don't do anything but continue my SIP. By 5th year, it's recovering back to 13%. And by 6th year, it's recovering back to 19%. So again, the same logic of maths applies. What happens is that inevitably, every time the market has recovered after a fall. So there's not a single instance where the market has not recovered. And you can see that overall, the market continues to go up. So as long as the market continues to go up, whatever is the logic that got applied when the market fell, the same logic applies when the market recovers, because how you had a disproportional downside impact when a large fall hit your SIP, you will also have a disproportional upside impact whenever the recovery happens. And as we can see, during a fall, you also end up accumulating more units. This is an example of 1 lakh SIP. So you can see that in Jan 20, Feb 20, before the COVID crash, you are roughly accumulating close to 6 units. Then suddenly it fell, and then you are roughly almost, you are accumulating almost close to 8.6 units. So you can see that, think about this like a grams of gold, right? Assume you were only able to get 5.8 to 6 grams of gold before COVID. And when the COVID hits, for the same amount of SIP, you are suddenly getting 8.6 grams of gold. So obviously you will be excited, right? Because so then the logic is that as long as the gold prices go up, then you benefit. It's the same logic that applies here. When there is a market fall, you end up accumulating more units. And when there is a recovery, all those extra units also participate. So overall, you find that the recovery leads to that very, very sharp jump. So suddenly you are at minus 15. By the next 1 or 2 years, you are back to plus 15, plus 16% kind of a number. So this sounds very counterintuitive, but this is purely explained by math. So any volatile asset class which grows over the long period of time is a brilliant asset class to look at for an SIP kind of investment. And in that, equity is a perfect asset class because it grows over long period of time and it is extremely volatile. So the key thing to remember is that it has to be volatile and it has to grow over long periods of time. So the idea is that 7 years you hold on, use the 5-finger strategy, and be prepared for all these 3 phases. Do nothing. Please tell the clients that do not stop your SIP during these phases. You have to continue, and then in the next 2 or 3 years, you will see a sharp improvement in returns. The last one stands for a very simple idea that every year you also need to increase your SIP. Now, this is a very simple example of a 5,000 rupee SIP without an annual increase. Like you do a 5,000 rupee SIP over 20 years, you end up making close to 50 lakhs. Now, if you increase it by 10%, you almost double the amount that you get after 20 years. So you almost end up with close to 1 crore. So for most of our clients, their salaries also increase. So, but however, they kind of forget to increase their SIP amount also in line with their salaries. So the simple idea of just increasing their SIP by say 5%, 10% can also lead to a significant jump in the overall final value, especially over longer time frames. So overall, putting it together, 7-year time frame is a very, very good enough time frame for your clients to get a good equity SIP experience. And a 5-finger strategy can be a good way to construct your portfolio. The third is there are these 3 tough phases, right? Disappointment phase, irritation phase, and panic phase. This is a given. It's not even like your clients are not unlucky that they go through this. Everybody will have to go through this. So this is a pain that they are signing up for. So it is inevitably bound to happen. Now, whether it happens first year, second year, third year, fourth year, we have no clue. But the good part is that if they survive the first 5 years and especially these phases without stopping their SIP, by the 7th year, they'll end up with good returns. And post that, the impact of larger falls on their portfolio will not be as bad as what they saw in the first 5 years. The last point is make sure that you also every 1 year, you increase your SIP. So this is the 7531 strategy. Now, also there are other questions which you might get from your clients, like what if you start your equity SIP and then the market immediately crashes? We tested for that. Every time so this was the 2000 crash, like the market had fallen 56%. We assume that you were the most unlucky and you started your SIP just on the top of the bubble. And then if we looked at well, obviously 1 year return was minus 5%. Your 5-year XIRR or SIP returns were 23%. 7 years was 34% and 10 years was 21%. So starting your SIP during a market crash or at the top of a bubble is actually works brilliantly. Then same thing we tested for 2008. You ended up with same kind of returns. 7 years was 15%, 3 years was 23%, 5 years was 11%, 10 years was 13%. So again, this worked out. And then we tested for all the other crashes that we saw in the last 20, 25 years. And you can see that it even inevitably by the 6th or 7th year, you end up making a phenomenal return. So in one case, in the 2004, you had started before a 27% fall. By 7th year, you were at 18% return. And 2006, had you started by the 8th or 9th year, you are at 10 to 12% return. And then 2008 global financial crisis, you are at 15% return after 7 years. And 2010-11 Euro crisis, where markets fell by 30%. After 7 years, you are at 14%. And then 2015-16, there was a 23% fall. There again, after 6 years, you are at 13% return. So overall, you can see that even if you start just before a crash, over a 7 year, 5 to 7 year time frame, you still end up with very, very good returns. Now, the next question is, should you add mid-cap exposure to your long-term equity SIP? The logic I told was simple, right? The more the volatile and the more, and if an asset class grows, then it's a perfect combination. And we all know that mid-caps are more volatile than large caps. And on top of it, they also end up outperforming large caps over a long period of time. So logically, intuitively, mid-cap should be a good bet for SIPs, especially. Let's see if that works. The blue line is mid caps. As we see over long periods of time, mid caps SIP comfortably outperforms large caps. And this is the 10-year rolling return that we did. Almost 12%, 94% of the times a mid cap SIP has given you more than 12% returns. Whereas for a large cap, it's only 60% of the times. And again, 70% of the times you have made more than 15% returns in a mid cap SIP. Whereas in a large cap SIP, there are only 3% times where you made more than 15% return. So overall, on average, you made 15% returns in a mid cap SIP. And on average, you made only 12% return on a large cap SIP on a 10-year basis. So overall, this is again supporting the view that more volatile but higher growth category like mid caps make a lot more sense for your SIP. So for clients who want to make it a little more aggressive, you can increase your exposure to mid caps as well. And this is something that we tested for all the periods. We saw this is the outperformance. So you can see that on a 7 to 9 year basis, you've always ended up outperforming, except for a few phases where you didn't outperform. Even those cases by the 9th year, you ended up outperforming. So on a 9-year basis, almost each and every time, you ended up making an average outperformance of close to 4%. Right? And the other way to also look at it is that even in periods where mid caps had gone nowhere, so almost for 6 years from 2008, mid cap returns were 0%, but an SIP gave 14% during the same period. Same thing happened here between 2018 and 20 mid, where almost for 3 years your mid caps went nowhere. But at the same time, if you did an SIP, you made 13%, because SIPs end up taking advantage of volatility because you're accumulating more and more units as they fall. And as and when they recover, your higher units end up participating. So even in flat markets, a mid cap SIP has worked really well. And the same logic even applies to a large cap SIP. So the next question that we keep getting is, which is the SIP frequency to select? Should it be weekly? Should it be daily? Or should it be monthly? And so what we did for last 20 years, we tested for Nifty 50. What happens when you do daily? What happens when you do weekly? And what happens when you do monthly? As seen below, there's hardly any difference. Almost you end up with the same amount. 14.44, 14.45, 14.45. So over long periods of time, it really doesn't matter if it's daily, weekly, or monthly. So our sense is go with monthly and keep it simple and keep the monthly SIP date as close as possible to the salary date, so that it's aligned with the salary cycle. The next question is, some people also ask, which is the best date to select? Should I keep it as 1, or should I keep it at 10, or should I keep it at 15? Should I keep it at 28, or different dates, right? Again, we tested for this. What happens when you do on first, second, third, fourth? So we just calculated all the SIP returns starting from these dates for the last 20 years. So we found that if you had started on first of every month for the last 20 years, you ended up with 14.47. Second, 14.45. So the key point is there's no major pattern and there's hardly any difference. So irrespective of whichever date you pick, it's probably in the second decimal that there is a 1 or 2 bips difference. But otherwise, broadly, the returns are more or less the same. So the key point is go for a monthly SIP and pick a date which is close to the salary date. So this is broadly something that we did on SIP, and we thought maybe would be useful for all of you to handle different client queries. So that's broadly what I wanted to communicate for today.
Thank you, Arun. Thank you all for your valuable time. We have a few more questions which will be addressed to you in your inbox. And we are eager to hear your views of the session. We've shared the link in the chat box for your swift feedback and response. And we'll also be sending a link via email. Please take 2 minutes of your time to respond to the same. Until next time, this is Sharon signing off. Have a good day.
Thank you. Thank you so much, everyone.